Hello, my name is Jim Penna. I'm the Manager of Retirement Services here at VectorVest, and I'm very happy to be hosting this week's special presentation, which is titled, Why Covered Calls Should Be Part of Your Portfolio. The covered call is the most basic of income strategies, yet it is still highly effective when done correctly and can be used by experienced traders as well as those who are new to options. Now I'm going to spend some time here defining and illustrating the covered call, but before I do, I wanted to share what I believe still is the best, most straightforward, most logical definition of a covered call that I've come across. I've been using it for a long time, and it comes from a gentleman named Lee Lowell, who wrote a book called Get Rich with Options that our founder and mentor, Dr. Bartolito, had read and passed it on down to us. And I found this quote a long time ago, and it is just a great definition of a covered call. And Mr. Lowell writes, if you own shares of a stock, minimum of 100 shares, and you're not selling options against them, then you are throwing away free money. There are traders out there who will give you money today for the right to take your stock away from you if it reaches a much higher price, which is the core of what a covered call is and why they can be so powerful. He goes on to say, selling covered calls is such a great strategy for padding your bank account that I still can't believe there are investors who are not taking advantage of it, and frankly, neither can I. My purpose here in this presentation is to illustrate why covered calls can be so powerful and why you should incorporate them into your money management. So here what I'd like to show you is, first of all, how a covered call works. I want to talk about some actual trades, some case studies that we've done, and those case studies will illustrate the four main benefits of the covered calls. And then I'll talk a little bit about the template for our 5-step covered call system. What I'd like to do now is just talk about how a covered call works, kind of lay the foundation here. And I want to show it what the trade looks like from both the buyer's perspective and, for our purposes on covered calls, the seller's perspective as well. So instead of just talking over a slide with a bunch of words on it, I want to try to animate the mechanics of a covered call here for you. So on the right side here, we have the option buyer, and on the left, we have our option seller. Now, the option buyer pays money to the option seller, and in exchange, the option seller writes a contract and agrees to it with the option buyer. Right? That's why an option seller is also referred to as an option writer. You're going to hear me talk about the buy right covered call. It means you buy a stock and simultaneously sell a covered call against it. Writing a call and selling a call are synonymous for our purposes here as we go forward. So the option buyer has paid for the right to buy or sell a stock if it were a put option. We're focusing on call options here, which means that, again, the option seller gets paid, but he takes on obligations. So we know there are two types of options, again, call options and put options, and we're focusing on call options here. So let's look at specifically what happens here with the call option. So once again, the buyer pays the seller and they enter into the contract. Okay, so the buyer now knows that he has the right to buy the underlying stock or ETF, and that the seller has the obligation to sell the stock to the buyer. When you see an option traded or an option chain, you might see something like this, or this is the information that is listed here, and this is just a basic option trade. One Apple June 150 call at 550. Okay, so if you're the buyer of the option, let's walk through this and break it down and talk about it piece by piece. So remember, we're talking about the call option. That's the type of option. Once again, the buyer has paid the seller, and we'll start here. What did he pay him for? Well, the one obviously is for contracts. How many contracts did the buyer purchase? And then, of course, the underlying asset, the stock or ETF. So the contract is one, in this case, one contract of Apple that the buyer is paying for. So he has now the right to buy 100 shares of Apple. And if the seller is assigned, he has the obligation to sell that stock. Next, I'll go to the strike price. Remember the strictly defined terms and conditions. The buyer has paid the seller and he has the right to buy 100 shares of Apple at a certain price, which is the strike price, at, in this case, $150 per share. So if assigned, the seller has to provide that stock at $150 per share. The next thing we'll look at is the expiration date. Remember, an option expires, a monthly option expires on the Friday before the third Saturday or the third Friday of the month. In this case, it would be June 17th would be the expiration for the upcoming June monthly expiration. Let's look at it again through the buyer's eyes. The rights to buy Apple at $150 a share expire on the third Friday of June, and the seller knows that his obligations end on the third Friday of June. And then finally, there's the premium. Okay, this is the amount of money that the buyer is willing to pay to take the seller's stock away at a higher price. So he's willing to pay $5.50 per share, or $550 for the right to buy Apple at $150 per share. So that really is the core of a covered call. Because the seller is long or already owns 100 shares of Apple in this case, he is covered because he owns enough shares to fulfill his obligations instead of having to go out into the open market and buy the stock. Okay, so there's the foundation. Let's go ahead and move on to an actual trade. And what I want to do with this trade, and I'm going to use it for several examples, is kind of show a what if scenario. Okay, what if our stock goes up? What if it goes sideways? What if it goes down? We're using Alcoa. Again, an actual trade we did in our coaching group. Here, Alcoa is trading at $74.04 per share. Okay, and you go out and sell a call option on Alcoa with a strike price. The buyer has the right to take my stock away from me at $75 a share. And in this case, we used an expiration date for this February trade of March 18th, and we took in $4.42 per share. Okay, I sold someone else the right to take my stock away at a higher price at a later date. What does that mean? Well, since one call option controls 100 shares, first of all, you received $442 for selling that right. Now, if Alcoa is over $75 at the expiration date, you would be obligated to sell Alcoa for $75 a share. In other words, at expiration, above 75, you would be what's called assigned, and on Monday morning, you would wake up less 100 shares of Alcoa in your account. So when the stock closes above the strike price, you will lose the stock. Now that's a good thing because you get to keep the capital appreciation as well as the $442, which we'll talk about in a moment. So again, since you own the shares, you'd sell your shares at the strike price of $75. That's what the definition again of the covered call. Now what if Alcoa is below 75 at expiration? So first of all, you will not be obligated to sell your shares, and then of course it would depend on where Alcoa went, and I'm going to show some examples of how you can profit whether the stock goes up, sideways, or even down slightly. So in this case, you would hold on to your shares and you would keep the $442, and then you'd evaluate whatever profit or loss that you have on your 100 shares. So you may have a profit of, up to, 95 cents. If Alcoa was trading at $74.99, you would not be assigned. You would keep your stock. You'd keep your $442, and you'd have the right or the decision to go out and just sell another covered call against it. Now, of course, the price of Alcoa can continue to go down. Remember, covered calls, selling a covered call against the stock you own adds absolutely no risk to the position. Your risk is inherent in the fact that you own the underlying stock. And so just like if you owned an underlying stock, you would have risk management techniques in place to mitigate those losses. And of course, there are option strategies where you could just continue to sell covered calls and continue to lower the cost basis. So that's kind of the what if chart. I want to talk now about the 4 benefits of covered calls. Now I'm going to come back to generate income. I'm going to start first with downside protection. Let's take a look at Alcoa again. Trading at $74.04 per share, we collected $4.42 in premium from this actual trade we did for the call that we sold. When we talk about reducing risk using a covered call, we just reduced our risk because we lowered our cost basis by $4.42 all the way down to $69.62. Right? $74.04 minus the premium received gives us, we call either the cost basis or the break-even price. So in this case, Alcoa could go all the way down to $69.63 and we'd still technically be profitable. Okay, so it does create a nice cushion there and helps to reduce downside risk. right? So that's our protection. That's nearly a 6% of the stock price, nearly a 6% built-in stop or cushion that you've just created by taking in that premium. So that's a great benefit of selling covered calls, especially in the current market that we're in. It helps to eliminate the greed factor. Well, how does it do that? What if you just bought shares of Alcoa when it was trading at 74 per share and it didn't do the covered call? Well, if you timed it right and you did everything correctly, the stock rose and you would feel very good about the trade that you just created. But for many people, what happens, greed kicks in and they don't know when to exit the trade. They start trading on emotion. They don't have a plan in place. And so what happens is many people call one of the disadvantages of covered calls is it's referred to as opportunity risk, right? Remember, my profit is capped at the strike price. My stock could be called away. So I risk that opportunity of capital appreciation. But what really happens to a lot of investors who may not be disciplined enough, right? If you didn't have the covered call, you'd consider, yourself a great stock picker. This worked perfectly. I'm going to ride this stock. If it went to 90, it could go to 100. And then what happens, right? The stock could turn over and you have nothing to show for the trade. Now, in this real world case here, the stock did rally again, but turned over. And the worst case is that you held it too long and watched the profits go away. If you did the covered call, your trade has a built-in maximum profit, which helps eliminate the greed factor and helps make you have a better plan to execute your exit strategy. So you would sell your covered call at a price where you're willing to lose the stock, and it'll be above the current price or where you bought the stock, so you are still taking advantage of capital appreciation. Now, in this particular trade, on March the 4th, we exited the trade and walked away with $914 of income. Our trading system allowed us to capture, in this case, our profit target. Again, as I said earlier, you can profit even if the stock doesn't go up. Sometimes a stock can look great when you purchase it, but after you buy the stock, it just doesn't do what you want, right? And it can be frustrating. So here's another great benefit of the covered call. This is Occidental Petroleum, another trade that we actually did in our coaching group. So a covered call can make you money even when your stock goes sideways or even down a little bit. And it's helped through a thing called time decay, or for the Greeks, it's called theta. Remember, an option is a depleting asset. Why? Because it has an expiration date. So the closer to expiration, the value decay in the value of that option, which is good because you're short the option. So in this case, we sold a covered call on Oxy with a 63 strike price, owning it at 59 and change here. And what happened? Well, the stock moved sideways, actually just basically flat from where we bought the stock originally. But what happened? After 3 weeks, Oxy went nowhere, but we closed our covered call with $448 of income. And then finally, we'll come back to generating income, which focuses more on what's called the buy right as opposed to selling calls against stocks you already own. Both of them very powerful strategies, but both with a little different rationale or objective behind them. But generating income is a huge objective to selling covered calls, and it always leads me back to a conversation I had with Dr. DeLito a long time ago, coming back from a trip from the seminars when we used to go on the road to do them. And I relayed to Dr. D that, one of the questions we get in some form or fashion is always, how do you keep from running out of money? And Dr. D just looked at me, and in the way only Dr. D can, he said, James, just tell him to keep making more money. And so we really took that to heart and talk about covered calls and good quality dividend portfolios for retirees. There are many ways to generate income, but covered calls is certainly a great way to do it. So again, just to reiterate these actual trades we did in our coaching group, we had, two very good trades on stocks, one that went up and then had some rough times after, and then again, another nice trade here. Now, that's not to say that every trade we do in our coaching group is, we don't have 100% winners, but the flexibility and versatility of options allows me to hold on to a stock and continue to sell covered calls in this downtrending bearish market that we're in. I'm still able to lower my cost basis and generate income. And if it's a good quality stock that's just getting hurt in this current market, or, a lot of them will continue to pay a dividend throughout. And so there's a great benefit to be able to continue to sell these. So back in 2021, We did 39 round trip trades. We had 79% winners and just under 20% total return on investment. 2020 was a little more favorable. After the pandemic sell-off, the stock market really took off and we were able to do a lot of buy rights. We did about the same number of trades, 76% winners, which I think are the key numbers here, right? We have more winners than losers because we have a proper system and we set it up correctly, set the trades up right. Which leads us to the 5-step covered call system. And I'm just going to lay out the template for how we do it here at VectorVest. And the first 2 steps are very basic, just as if you were buying a stock, because you are, right? If you're doing the buy right or if you already own the stock, again, the rationale is a little different. When to trade, of course, for a buy right, it's a more bullish outlook. And so, of course, I want the overall market to be in an uptrend. And one of the key signals, at the very least, I want to see the green light buyer, or in other words, a green light in the price column of the color guard. Next is the what to trade. Well, just as if you were building a portfolio of quality stocks, I always tend to start with high relative safety stocks. Again, the stock must be in an uptrend. If it's in high RS stock, earnings are probably already rising. If I jump into the program quick, I just want to bring up a market timing graph and talk a little bit about, again, the power of the covered call and how it relates to where the market is and those different rationales. Now, a great time to have started to sell covered calls against stocks in your portfolio is when the MTI or the market has moved up. We had a confirmed up, took us to the confirmed down. You can see how the MTI started to turn over. Good time to begin to protect positions. This is more of a defensive measure when you sell them here, which would have been a great time starting November of 2021 to begin selling covered calls against stocks that you already own. And then the flip side is when the market finds a bottom, and eventually it will, we can begin to sell covered calls. Now again, that opportunity risk that I talked about might cause hesitation for some to sell covered calls because they miss out on that potential big move in the stock. So remember, if your objective is income, if your objective is income and some capital appreciation in a trading system that you can manage, then there's never, a bad time down here to sell covered calls. And then as to the what to trade, I can tell you that the searches that I would point you to are in the Unisearch tool. Click on Unisearch, come to the search directory in the retirement portfolio. You've got one is Premier Growth Stocks, which is a great search. And then in the Prudent folder, you also have Ruler Stocks, my very favorite search in the program. And then one thing we like to do is change the price of the stock because you do have to own 100 shares of the stock. So you can always set in the Unisearch tool a price limit, right? So I can say I want stocks only that are under $100 per share to be able to buy at least 100 shares, or you can set that price to wherever you'd like. And here would be some good candidates. And again, there are several searches I would use. And here are some good candidates that I would look at. So when to trade and what to trade, the most powerful tool you can have is the VectorVest program to help you do that. Then comes the trade setup, right? Once you have your stock candidates, you want to be able to set up the best covered call. Basically what we do, among other parts of our system, is that we choose out of the money strike prices, usually 1 or 2 strikes out of the money, depending on the increments in the option chain. If they're $1 increments, they could be $3 or $4 out of the money, as we saw with Oxy. And then we use that industry standard window of days to expiration of 30 to 45 days to expiration. Now next is trade management. And once you place your trade, you really need to have rules in place to manage that trade. Just like when you own a stock, you have to know your stop criteria in advance. And the truth is you can do all of this to perfection, but it's useless if you don't know how to manage the trade once you're in that trade. We talk about things like calculating our max profit on the trade if we are called away. What is our return on investment? And then what I do is use an 80% of that max profit as a investment plan or a trading plan. It eliminates greed. It gives me a proper target, and once I hit that 80%, we close the trade, just as we did in Alcoa. And then of course, just as if you owned a stock, you would also have your stop criteria. And then finally, there's order entry and just some basics, just again, as if you were buying a stock. We try to use the midpoint. We show you how to use uh, the aggregate or the single order to simultaneously buy a stock and sell a covered call if you're doing the buy right. We'll show how to use, try to middle the trade, which is important many times. But the one thing you want to eliminate is market orders. You never, for any trade you do, just stay away from market orders. But it's also a very important part of the 5-step plan. So this is the system that we do each week in our coaching group that we teach our subscribers and our students, and it's been working very well for us. And it goes back to Dr. D's quote, how do you keep from running out of money? Well, just keep making more money. And that is the power of covered calls and why I believe they should be a part of your portfolio. Now, if you're new to covered calls, I'd like to take just another minute or two to show you how you can place your first covered call trade in just 7 days. We have the system to do it, and we have put together what's called the Covered Calls Bootcamp. And in just 7 days, you'll be fully trained to place your very first covered call. And if you're managing your net worth, your retirement nest egg, it should be part of your risk management process. Let me show you quickly what's involved in the Covered Calls Bootcamp. First, we'll talk about what an option is. We'll go into greater detail. We'll talk about, again, how the covered call works. And that's all important stuff, but it's kind of useless if you don't have a plan. So the when to trade, what to trade, the trade setup, how to manage that trade and enter not only the trade, but how to enter your profit target trade, how to enter your stop order, how to calculate how to do that. We go through all of that in the course. I'll teach you this live, and you'll have access to all the training videos in case you miss a live session or want to review the videos. You have access to it for a full year. We believe so much in the course and that you'll successfully complete the bootcamp that we offer a 100% money back guarantee. So you can go through all of the bootcamp, show that you've done the work. If you're not satisfied, we'll give you all your money back. So it's a no risk trade for you. Here's a quick schedule for the course. It begins on the 24th of May, which is a Tuesday. Our training begins 4:30 each day. We'll have live seminars. If you can't make the live seminar, we will post it in the VectorVest University, where we keep the resources for all of our courses. We're off on Monday. We come back the following Tuesday, and on Wednesday, June 1st, we'll have placed our first live trade, and we'll review that trade, and then we'll spend the next couple of days answering any and all questions on the content of the course. If you join now, you can get a head start. Training videos are available immediately to you. And if you go to www.vectorvest.com/cc bootcamp, it will bring you to this registration page. This price of $495 is good until Monday afternoon at 5 p.m. And at that point, it will go up to the regular price. You can get a complete description and an overview of the course here. We have an interview with one of our former trainees. So there's a lot of great information there. Go ahead and click Purchase Course Now so that we can show you how to make covered calls a very important part of your portfolio.